What if I told you that dedicating just $300 every single month could fundamentally transform your financial future and allow you to retire decades earlier than most people ever dream possible? It sounds almost too good to be true, but the math behind it is surprisingly elegant and accessible to anyone willing to commit. If you're tired of living paycheck to paycheck and dreaming about a future where your money works harder than you do, then you're in exactly the right place. Make sure you subscribe to this channel because we're breaking down the exact mechanics of how disciplined monthly investing compounds into genuine wealth and freedom. The strategy we're about to explore isn't flashy, it isn't complicated, and it doesn't require you to be a financial genius or have a six-figure salary. What it does require is consistency, understanding, and a willingness to think long-term about your money. The foundation of this entire approach rests on a concept that Albert Einstein allegedly called the eighth wonder of the world: compound interest. When you invest money and it earns returns, those returns themselves earn returns in a continuous cycle that accelerates exponentially over time. $300 might seem modest in isolation, but when that money sits in the market for 2, 3, or 4 decades, something remarkable happens. Let me walk you through the actual numbers so you can see this isn't speculation or wishful thinking. Imagine you're 25 years old and you commit to investing $300 every single month without fail. You place this money into a diversified index fund that historically returns about 10% annually on average. That 10% includes both market growth and reinvested dividends, which is crucial because reinvestment is where much of the compounding magic happens. After 1 year of consistent investing, you've contributed $3,600 out of pocket. But thanks to that 10% return, your account is actually worth approximately $3,800. You've earned $200 that you never actually worked for. It's a small victory, but it's the beginning of something powerful. Most people stop thinking about investing at this point because the growth feels negligible. They notice they've only earned $200 and they think, why bother? This is precisely where discipline separates the wealthy from everyone else. Fast forward 5 years into the same investment journey. You've now contributed $18,000 of your own money, but your account balance has grown to approximately $24,000. You've earned $6,000 purely from compound growth. That's a 33% bonus on your contributions. The returns are now outpacing your effort. Skip ahead another 5 years, and you're at year 10. Your cumulative contributions are $36,000. Your actual account value is now pushing $64,000. In just the second 5-year period, you earned an additional $40,000 without adding any extra effort beyond your regular monthly discipline. The compounding is accelerating. This is where the mathematics becomes truly exciting. At year 20, you've contributed $72,000. Your account has swelled to approximately $191,000. You've earned nearly $120,000 in pure compound growth. Your money is now earning more annually than your monthly contribution. At year 30, you've contributed $108,000. Your balance exceeds $617,000. You've earned over $500,000 from compounding alone. And here's the beautiful part. At year 40, your $300 monthly investment has transformed into nearly $2.1 million. You've only put in $144,000 of your own money, but the market has generated approximately $1.9 million in growth. This is the power of time married with consistent investing. Now let's talk about retirement, because that's the real magic here. The traditional rule of thumb in financial planning is the 4% rule. This principle suggests you can safely withdraw 4% of your invested portfolio annually without running out of money over a 30-year retirement. If you've accumulated $2.1 million, 4% of that is $84,000 per year. That's $7,000 monthly. For most people, that's a comfortable living standard. But here's what's even more important. You achieve this through just $300 monthly while working. You invested during the years when you had earning potential and let the market do the heavy lifting during retirement. Most people never achieve this because they don't start, they don't stay consistent, or they invest in the wrong vehicles. They might keep their money in savings accounts earning 0.05% interest, not recognizing that inflation is gradually stealing their purchasing power. Or they dabble in individual stocks, get emotional about market volatility, and sell at the worst possible moment. Or they simply don't prioritize savings because they're caught in the cycle of lifestyle inflation. Every time their income increases, their expenses increase proportionally, leaving nothing extra to invest. Breaking that cycle is often harder than the actual investing part. The consistency aspect cannot be overstated. $300 monthly is approximately $10 daily. That's the price of a couple of coffee shop drinks. What would your life look like if you eliminated those daily lattes and instead redirected that money into your future?